Hello and welcome to a discussion on Chapter 3, Preparing Your Taxes. This is a great chapter to teach because it's relevant to everybody. If you've ever had a job and made over a certain amount of money, you've had to file your taxes. So this chapter is pretty relevant. We're going to be actually learning how to do a simple tax return, and we're going to be learning the tax formula. So let's jump in and take a look at, I'll use the PowerPoints to guide us, but we'll also be jumping over to, the IRS website so that you can see where to get the forms and how to use them. So I'll put this on slideshow, view show. So what we're going to be doing, I'm just going to put me down here. Doesn't matter. We're going to be looking at basic principles, different kinds of gross income. We're going to be spending a lot of time preparing a basic tax return. There's 2 actual lab chats that go with this. And those are the lab chats will take you through preparing a tax return. That'll be one of the key takeaways for this chapter. We'll look at who needs to pay estimated taxes. I mean, you can read all this. So this is the overview of what we're doing. So taxes really impact everything. Your savings plan, your retirement, estate planning, everything. We're also going to be looking at Social Security taxes, which take up 7.65% of your gross paycheck, right? So that's partially Social Security and partially Medicare. We're going to, hopefully after this chapter, you can prepare your own taxes or to better understand when somebody else does your taxes and then they give them to you, what you've got going on. Sorry, just save this here. Okay, so what I'd like to do now, sorry, let's get started here. So the question is, I mean, everybody bitches and moans about taxes, but how much do we actually really pay in taxes? And what is the combined rates? Well, there's a couple things that go into answering that question. Half of all wage earners pay no income tax at all. And the reason that they don't pay any income tax at all is that their gross wages are less than something called their standard deduction. Everybody gets a standard deduction. And if you make less than that, then you're not going to have an income tax bill. But everybody pays Social Security of 6.2% and Medicare of 1.45%. So put that just in the back of your mind right now. We'll be coming back to this quite a bit, but if you, even if you don't pay income tax, you're going to pay 7.65% of your wages into this system here. And then your employer matches it. So there's a total of 15.3% that's going in for Social Security and Medicare, which are basically our safety net programs that were established by FDR in the 40s. And then it goes on to say, so half of nobody pays income tax. People that make $250,000 a year or more are about 2.5% of the tax returns and paid about roughly 50% of the income tax. So it's clearly weighted towards revenue raising from higher income people. Okay, basic concepts here. This is just basic concepts. Any kind of tax is some sort of rate times some sort of base. So like if you have property taxes, for example, on your truck or on your home or on your RV or your four-wheeler, it's the value of the property is the tax base and then some sort of rate is applied. With sales tax, your base is whatever the sales are, right? And then that's times some sort of rate. Income tax, your tax base is something called taxable income. Remember that term. Everything we're going to be doing today is going to be trying to get you to taxable income, to calculate taxable income, and then we'll go find what tax rate to use. So you can lower your tax by doing one of two things, by lowering the tax rate or lowering the tax base. And then there are in income tax some really special types of income that are taxed at different rates. One of those is called long-term capital gains. And that's if you buy and sell like stocks and bonds or real estate or coin collection, something like that. And you make money on that, you are taxed at a lower rate than just a regular income tax. And you can also lower your tax base by increasing the amount of deductions you have or exclusions. And these are probably words you're not super familiar with. So if you could take a moment and turn to page 98 in your book, you may have an ebook or a hard copy book, whatever. Pause the lecture, go find that, because I want to look at this formula together. So pull up page 98, please. Go up here and find a picture of it. So this is what's on page 98. And I was talking about taxable income is the tax base. So this is really critical that you learn this. This is really the crux of chapter 3. And it says calculating TI, which is short for taxable income, and the total tax liability owed. So how do I figure out down here? That's what everybody wants to know right away. What's my tax liability, and do I owe, or am I going to get a refund? So step A, we have to determine adjusted gross income. From there, we can go to step B to calculate taxable income, the magic number, and from there to step C to calculate the liability. So adjusted gross income is all your items of income. So, interest and dividends and rental income and W-2, and maybe you're self-employed. So all your elements of gross income minus a set of deductions, tax deductible expenses. These are called adjustments to gross income. And those are things like, there's a long list of them, but the ones that are probably most common is like if you contribute to an IRA, or if you contribute to a health savings account, or if you pay student loan interest, or if you're, those are the most common. If you're self-employed and you pay health insurance premiums. So these are things that are high impact. Lots of people have write-offs here, adjustments to gross income, tax deductible expenses. Now, I'm just going to tell you this now, you'll hear this again, but these adjustments all go on something called a Schedule 1, and we'll look at that on the IRS website. Gross income goes on the face of your 1040, right? That's the actual Form 1040 is the tax return. These go on a Schedule 1. Then the gross income minus the adjustments gives you something called AGI, adjusted gross income. Then you get to subtract one of these two numbers, either itemized deductions or standard deduction. Everybody gets a standard deduction. And if you're able to add up a whole bunch of things called itemized deductions and that number is larger, then you get that. But most of us take standard deductions. Really, the only people that usually get itemized deductions is if they own a home and pay mortgage interest. Okay. Don't pay attention to this. There are no longer personal exemptions. You can see here that those are suspended. So AGI minus the larger of your itemized or your standard takes you to this magic taxable income number. Then we go to the tax tables. We calculate our tax. I'll show you how to do that. And then you get a dollar for dollar reduction for anything for which you qualify to have a tax credit. So these are really, really valuable. For example, if you have a child under 17 that's your dependent, you get a $2,000 tax credit per child. So that can really reduce the amount of your tax. There's tax credits for paying tuition at University of Montana, any institution of higher education. There's the earned income credit if you work and you're lower middle income. So you get to subtract all your credits. Then you may have to add on some other taxes. That's a little beyond our scope. We won't talk about that, but those are like, I'm not going to talk about that, but that's not going to impact us. And then you get to your total tax liability. You still don't know whether you owe or whether you're going to get a refund, because once you get your tax liability, then you need to compare it to what you've paid in, right? Most of us pay in on our with our wages, right? So our employer withholds federal income tax from our checks. But if you're self-employed or you have lots of other kinds of income, you would make something called estimated payments. So the best thing you can do, honestly, as you start to study this chapter is really memorize and understand this formula, because this is going to go exactly to the 1040 and we're going to use the same formula. Okay, so now stick with me here. In your book was published a couple of years ago. Everything in there is from tax year 2018. We are going to do everything in 2018 because I want you to be able to use your book as a reference and use the tax tables that are in the book. It hasn't changed dramatically. You can see that the rates, are a little bit, the brackets are wider in 2021, but honestly, we're going to use the 2018 tax tables and tax forms and notice that there's a difference. Now, first thing you're going to see is this is the rate that applies to taxable income. So if your taxable income is between $0 and $9,525, you pay 10%. For every amount over that, you pay 12%. Then when you jump up here, you're going to pay 22%. But just be really clear on this, that, I may make $2 million a year as an oncologist, but I still pay 10% on the first 9,500 and 12% on the amount from 95 to 38, 22 on the amount from 38 to 22, et cetera, et cetera. It's really, once I get over 500,000, all of that's taxed at 37%, but these brackets that came up to the 500,000 are the same for everybody. And you can see here the numbers are a little bit greater, but the 7 brackets are the same: 10, 12, 22, 24, 32, 35, and 37. This is referred to as a progressive tax rate, okay? No matter what, the first amount, just what I just said, the first amount's taxed at 95 or at 10%. The next amount between that 9,500 and 38,000, the difference between those brackets is 12%, and so on. So no matter how much you make, all filers who are single pay 10% on the first $9,525. And let me just point that out. These are tax rates for a single taxpayer. If you're married filing joint or head of household, you're going to have different rates. Okay, and just to compare that, so income taxes are progressive. Sales tax, which is a flat rate, are regressive, because we pay sales tax on what we consume, right? Our milk and diapers and gas and what have you. That amount, that flat rate, usually impacts lower income people more predominantly, because they spend a larger part of their income on their disposable goods. Now, this is something important that we have to learn: the difference between average taxes and marginal taxes. So again, if you want to go ahead and pause, this time we're going to work through a problem that's on page 109. So go ahead, find page 109. The name of the folks that we're going to be looking at is the Butler family. Stop the video and I will meet you there to do these calculations. Sorry, I'm trying to get my. Okay, so on page 109, this is a 1040 for the Butler family. And again, you can see it's for 2018. And you can look up, we just learned about all the different kinds of gross income. Those are on lines 1 through 5. And then you've got your total income numbers in line 6. It doesn't look like there were any adjustments to gross income. So it's the same number on line 7. Here's that standard deduction that we were talking about. And you can see over in the far left-hand column, it tells you your standard deduction if you're single is $12,000 bucks. Everybody gets that. I'm over in that on page 109 in the column that talks about standard deductions. If you're married filing jointly, you get $24,000. If you're head of household, 18. So it looks like this is a married couple, so they get $24,000. Don't worry about line 9. And their taxable income is $48,445. So the first thing that I would like you to do is let's go figure out the tax. Well, they're married filing jointly. Okay, sorry, forget that. They've done the tax for us. We can't use the single tax tables for them because they're married filing joint. So it looks like they calculated the tax on line 11B. So their gross tax liability is $5,432. And then they had other taxes of $820. And their total tax was $820. And the amount that they had withheld was $7,410. Okay, so their tax bill is $820. They had some big credits up here in line 11. So what I want to do is see if we can figure out their average tax rate and their marginal tax rate. So their tax was $820. And their taxable income, you can find on here, was $48,445. Please go ahead, stop the tape and do that calculation. Then go back to the tax tables that we were looking at and see if you can determine their marginal tax rate. In other words, what was their highest bracket? And I just want to make a point at how different your average tax rate is from your marginal tax rate. So stop the video and go get those two numbers and then we'll talk about it. So $820 divided by taxable income of $48,445. It looks like, and take it out to a couple places, I think it's 1.7%. So that was their average tax. Their marginal tax rate, because they had TI of $48,445, I would go and say, oh, and again, this is, sorry. These are single tax. These are single brackets. Their marginal tax rate is the tax on the last dollar of income. So you would have to go to the table for married filing jointly and see where they fell. And they actually fall at 12%. There's 5 different kinds of filing statuses. We're not going to be dealing with this too much. We're really just going to be working with the most simple, which is single, but there's also married filing jointly, married filing separately, head of household, which is when you're single, but you have a dependent, and for like a single parent, or you're taking care of your folks or whatever. And then surviving spouse is if you are recently widowed and you have a dependent child with you. So important to understand that we're taxed on something called our gross pay, right? So if I work 20 hours a week and I make 20 bucks an hour, my gross pay is 400 bucks. Well, obviously that's not what I bring home. I've got to reduce my check by my income taxes, by my Social Security, and by my Medicare taxes. And which are, again, remember that's 7.65%. And then the cost of any benefits like health premiums or retirement or whatever. So I take my gross pay, I reduce it by all that, and that is my net pay or my take-home pay. My employer is going to determine how much income tax to withhold from my check based upon how much I make and the number of withholding allowances, which is essentially, if you're single, it's either going to be, and you don't have any kids, you're either going to choose 0 or 1. And if you choose 0, you're going to get more taxes taken out and hopefully increase your refund at the end of the year. Okay, we've already looked at this. I'm not going to spend a lot of time on this, but again, I think that I had said capital gains are taxed at a lower rate. So you can see here, if you're in the 10 or 12% regular bracket, you pay 0% on your long-term capital gains. And if you're in the 22, 24, 32, or 35, you only pay 15%. So these are taxed at a much, much lower rate. This is past our scope to calculate this, but just so that you understand that. And then if you have capital losses, so you actually sell stocks or bonds at a loss, you can only take $3,000 a year. So you're limited to that. Okay, so what I'd like to do is let's pull up a 1040 and look at, we kind of looked at the butlers, but that was married filing jointly, probably not the very best example. Please excuse me for that. We're gonna pull up 2018 1040 and a Schedule 1. I'm gonna show you how to get them on the IRS website. And then we're going to go through, this. Now, again, before we do that, I want to reiterate with the line that says standard deduction or itemized deductions, it's $12,000 if you're single, $24,000 if you're married filing jointly. Those numbers have increased. They go up every year according to the Consumer Price Index. So they're higher in 2021. But again, we're just using 2018 numbers. So let me get out of here and go to the irs.gov website. So this is where you're going to be getting your tax forms, irs.gov. And then you're going to go down here and get forms. And then because we're dealing in 2018, I've got to go to prior year. And let's see, where am I? 2018, here's my 1040, and here's my Schedule 1. And that's really what we're going to be working with. You might want to print a couple of these to use with the lab chats, or at least just a bare minimum, have it up on your screen so that you can fill it in with your keyboard. But if you can print, if you have access to printing, it's really, that's really best. It's a very easy way to learn. So I'm going to bring up my 1040, which is basically what we just looked at. And then let's see, let's download that. And then I'm going to go back. I'm going to go back and pull up the Schedule 1, and then we can look at both of those. And here's our Schedule 1. Same thing. Okay, so let's start with the 1040, which I just saved somewhere and now I can't find. Actually, let's start with this. So the Schedule 1 is if you have any items of income that aren't on the face of the 1040, and then down here are all those deductions, right? Adjustments to income, all the things you get to subtract. So the kinds of things that you might need to add, you know, here's your capital gains. Here's if you've got, you know, a rental real estate. Here's if you have a farm or some unemployment compensation. These are all things you would need to add as elements of gross income, but they're not right on the face of the 1040. Here are those items I was talking about that you get to subtract. And I think I said like IRA deduction, self-employed health insurance deduction, student loan interest deduction. Those are some of the more common ones. So you only would do a Schedule 1 if you have any of these items. On the 2 lab chats, one of our people is going to have, one of our lab chats is, the gal's going to have student loan interest deduction. So you're going to need to fill out a Schedule 1, fill out this line, and then I'll show you where to take it. So you can see on the 1040 on the second page, if you had anything from Schedule 1, line 22, which was the additions to income, you would include it here. If you've got some adjustments to income, it says right here, subtract Schedule 1, line 36 from whatever your gross income was here. So say, for example, you had $5,100 of wages, and then you also had $2,000 of rental income. There's nowhere to put the rental income here, so that would have had to have gone onto the Schedule 1. So my total income is gross income is $7,100. And then let's say I put $1,000 in my IRA. So on Schedule 1, I filled that out, right? That $1,000. It says here, enter the amount from line 6. Otherwise, subtract Schedule 1, line 36. Well, Schedule 1, line 36 shows my $1,000 deduction. So I'm going to subtract that from that $7,100. Then my standard deduction or itemized deductions, I don't itemize. I go over here, my standard deduction is $12,000. What's happened to my taxable income then? $6,100 income, $12,000 of standard deduction. I don't have any taxable income. So anything that I've paid in, I'm going to get as a refund. So that's showing you basically through these last slides, subtracting adjustments to income, that was my IRA or, you know, all the other ones, gives me AGI. Then I subtracted the greater of my standard or itemized deductions. And then I get my taxable income and I go to the tax tables. Well, in this case, I didn't have any taxable income, so there was nothing to go to the tax tables for. But obviously, when we work on some more of these, we're going to have taxable income and have to go calculate the tax. Once you get the tax, you subtract the dollar for dollar tax credits, and that gives you your gross liability. Then you compare that to how much you paid in, and that's the amount due or the amount owed. So just to finish us up, let's go. Where is my tax return? So in this example, my tax is going to be 0. And say that I had paid in with my W-2, I'd paid in $745. Add lines 16 and 17, 745. I'm going to get that all back because I didn't have a tax bill. Okay. What if this all looked very similar, except for I had $15,000 in $15,100 in W-2 income. See if you can figure out, and I still have that I've got $2,000 of rental income. I've still got the $1,000 that's on my Schedule 1, line 36. What are these numbers going to be now? So 15,100 plus 2,000, 17,100 minus the $1,000 IRA contribution minus the standard deduction. I've got TI of 4,000. Now let's go to the tax tables and calculate the tax. Single, 4,000, 2018. Taxable income is between 0 and 9,525. So super easy. It's just a straight up 10%. Okay, straight up 10%. Super easy. 4,000 times 10%. Tax on line 11, $400. I don't have any kids. I don't have any credits. Subtract line 12 from line 11. My tax is $400. I don't have any other additional taxes. And then let's say on my W-2, it shows that I had $2,100 withheld for federal income tax. Federal income tax withheld, 2,100. Add lines 16 and 17, 2,100. Therefore, I overpaid $1,700. Oops. And that's the amount I want refunded. So that's just a basic overview. The first page is where you put the name and social security number and where you sign it, etc. And then the second page is where you put the detail. And you'll also need to know how to do a Schedule 1. We will do those in the lab chats. Okay, let's see where we left off here. Okay, standard deduction, we know 12,000 and 24,000. Everybody gets those unless itemized or bigger. Well, what are itemized deductions? Those are things like medical expenses, you get part of them, state taxes, interest on your mortgage, charitable contributions. Again, really the only time people usually itemize is if they have a mortgage. Then you add all those up, compare them to the standard deduction, and use whichever is greater. Again, these credits, super, super valuable. A deduction reduces your taxable income and your AGI, but a tax credit is a dollar for dollar reduction in your tax. So they're super, super valuable. Common credits, that $2,000 per dependent child, education credits, daycare credits, earned income credit, all very, very valuable. In our tax system, we have a pay-as-you-go method, which means if you work, you have to have taxes withheld as you go. If you're self-employed, you have to pay estimated taxes. So you have to kind of guess what you think you're going to owe and then write out a check and send it to the IRS quarterly. Everybody can file a Form 1040. If you're over 65, you can file a senior. We've looked at a 2018 1040, and then you've got all these different kinds of schedules you can attach. Again, we're going to be sticking with Schedule 1, but there's obviously a lot more of them. You can use tax prep software, or you can do it on your own. Again, here's your 1040. Here's your Schedule 1. And we were talking about that IRA contribution. That would go here. Oops. Here in line 32, you put that 1,000 and then add it all up. And there's the 1,000. If you're super high income, there's some additional taxes you have to pay. You have to pay 3.4% of your investment income if you make over 250, and then you have an additional 0.9% Medicare if you make over 250, married filing joint, 200 single. So taxes are due on April 15th, income tax, federal income tax. Last year, I think we got a month extension with COVID. That's not what this is talking about. This is talking about when you personally are like, I'm not gonna have my tax return filed on time, I need to extend. You can get an extension until June, and that just rolls over to October 15th. So you can essentially buy yourself a 4-month extension. If you get audited, this is basically just telling you to keep calm, gather your records. If you made an error, learn from it. You will have to pay tax and penalties and interest on the amount that you underpaid. There's lots of different places to go to get your taxes prepared. Enrolled agents, CPAs, et cetera, et cetera. Generally, once your tax return gets even remotely complicated, most people will come to a preparer. But I'm hoping at the end of this chapter that you will feel empowered to just do like your simple tax return if you've got a W-4 and maybe an educational credit. There's lots of software, lots of people use TurboTax. There's some free filing software on the 1040 on the irs.gov website. You know, the software asks you a whole bunch of questions and then it basically plugs it in. I'm sure most of you e-file and also receive your refunds electronically deposited. That speeds everything up. So I would advise you next to go read the chapter, go through the homework, and I'll put the solutions up so that you can, my dog going crazy. I'll put the solutions up after the homework's due so that you can see what you did, and then you can work any more homework that you feel like you need to do. My dog's going nuts back here, shaking a towel. Sorry. Anyways, hopefully this will be something that will allow you to move forward doing your own taxes. So let me know if you have any problems. Make sure to do the lab chats, print out your 2018 1040s and Schedule 1s. We're going to be looking at W-2s and then actually preparing the tax returns together. So thank you for your attention.